Today we're going to talk about stop-loss insurance. Here's an overview. First we're going to go over what it is. Then we're going to cover who's insured. Then the types of coverage, specific and aggregate. And next we'll take a deeper dive into how it's written, the plan documents, how we define losses, and the paying of claims. Let's get started. Alright, so first off, what is stop-loss, otherwise known as excess insurance? Stop-loss insurance is used to provide coverage and protection for employers who choose to self-fund their health plans. This type of coverage is in place in the event of an unforeseen large claim or a group of large claims. So who's insured? Unlike traditional insurance coverage, stop-loss covers the employer rather than the employees. There are two types of stop-loss coverage, otherwise known as reinsurance. There is specific and aggregate stop-loss. Specific reinsurance is used to protect the employer against any single large claimant, or in other words, abnormally large claims from a single individual. Thus, this is otherwise known as individual reinsurance. Aggregate reinsurance, on the other hand, provides a max to the amount of claims an employer will pay during a given period. This provides protection for larger claims in total than the employer expected for the plan year. If you like this content, please consider subscribing. Alright, now let's dig a little bit deeper. How are these plans written? Oftentimes, coverage is written through a trust. The trustee of the trust becomes the insurance policyholder. Employers who apply and are accepted for stop-loss coverage are participating employers in the trust. The plan documents. The plan docs explain the benefits available to the employees. Because of how customizable the reinsurance plans are, the employer has many options. After the details are ironed out, the underwriter approves the plan structure and the stop-loss coverage is finalized. How are these losses defined? This is how expenses are determined to be reimbursable. Criteria 1. The loss is covered under the definition of a loss in the stop-loss policy. Criteria 2. The expenses must be eligible under the employer benefit plan that was previously approved. So how are claims paid? First, stop-loss is provided on a reimbursement basis. So the first step is for the employer to pay the claims. For specific claims, they are submitted and processed as soon as the deductible is met. For aggregate claims, they're processed at the close of the contract period. Sometimes there are monthly accommodations. Here, the employer can request the current ag claims to be compared to the deductible for earlier payment. We hope you enjoyed this. Check out the other videos on our channel and don't forget to subscribe.